Okay, I think we're good to go. Hi, everyone. Welcome to our Trends and Regulation of Digital Assets webinar. My name is Wendy Harada, and I'm a Senior Associate on the Professional Services team here at the Block Research. I am thrilled to be your moderator for this exciting panel discussion. Today, we have an excellent lineup of panelists who will be sharing their insights on current regulatory trends in the US, touching upon global developments, and offering their perspective on the future of digital asset regulations. Before we dive on to the discussion, let's take a couple moments to introduce our distinguished panelists. We'll go around in alphabetical order, and each panelist will briefly introduce themselves, including their name, where they work, their role, and any additional information they'd like to share. I think we can start with Meagan.
Thanks so much, Wendy. My name is Meagan Griffin. I'm counsel at Paul Hastings, and I've been working in crypto predominantly on the state licensing and MSB, FinCEN, and sanction side for a number of years now. It's a fascinating ecosystem, and I am really looking forward to getting to dive in today with my esteemed colleagues here. Thanks so much.
Next, we have Mitzi.
Hi, I'm Mitzi Chang. I'm a partner at Goodwin Proctor, and I'm the co-chair of our digital currency and blockchain practice, which was started in March of 2015. It's been a fascinating ride. I'm a corporate securities lifecycle lawyer by training, and have really enjoyed advising clients in the space. Looking forward to chatting today.
Next, we have Michael.
Hey everyone, I'm Mike Selig. I am counsel at Willkie, Farr, and Gallagher in our New York office. I discovered crypto around 2011, actually right before I joined the Commodity Futures Trading Commission, and worked with former chair Christian Carlo on some of the early Bitcoin-related products at the CFTC, and have since moved into private practice, and I focus on securities and commodities regulatory issues touching the crypto asset space.
Next, we have Jeremy.
Hello, everyone. Pleasure to be with you. Jeremy Sheridan. I'm a managing director with FTI Consulting in our blockchain and digital asset practice. I lead the investigative mission related to that practice. My background's in enforcement. I spent 25 years with the U.S. Secret Service. I've also done regulatory affairs work in the private sector following my retirement. Look forward to being with you all today.
Next, we have Robert.
Hi, everybody. I'm Robert Musiala. I'm a partner at BakerHostetler, where I co-lead our firm's blockchain and digital assets practice. I've been working in the blockchain space since 2012. I first learned about Bitcoin when I was investigating it way back then. And I now co-lead what I call a first full-service blockchain practice, where we are advising clients across every corner of this industry.
Our last panelist is Tiffany.
Thanks, Wendy. Hi, everyone. My name is Tiffany Smith. I'm a partner at WilmerHale and co-chair of our blockchain and cryptocurrency working group. And my practice focuses on advising crypto companies about the federal securities laws. And then, unfortunately, when the SEC brings an enforcement action, I represent them in defense. So happy to be here.
As you can see, we have a fantastic group of experts joining us today to explore the exciting world of digital assets regulations. As we proceed, please don't hesitate to type any questions you have into the question box. We will set aside some time for Q&A during the final 15 minutes of the webinar. I think we can jump right into the discussion. First question is, how do you perceive the current regulatory landscape for the crypto industry in the US? I think we can start with Robert.
Sure, thanks, Wendy. In 2022, I used to say that we were experiencing a double down in enforcement here in the US. And my soundbite for 2023 has been, we're now experiencing a triple down. And I think that is the easiest way to kind of provide an overview of the current environment. I think that in the absence of major legislation or major court decisions or some combination, we will likely see a quadruple down next year. And so that creates a very difficult environment. And in general, I say to clients that because crypto assets fall within so many different regulatory frameworks here in the US, you really have to have, and I used to say a 4-pronged strategy. These days I say it's a 5-pronged, but I used to say that you have to have a strategy for dealing with FinCEN regulations and anti-money laundering laws, a strategy for dealing with tax regulations from the IRS, strategy for dealing with SEC laws and regulations, and then a strategy for CFTC, Commodities Future Trading Commission laws and regulations. And I would now add a fifth to that, which is I encourage clients to have a federal policy strategy. And we're at a critical phase right now where I think there is an opportunity to sort of influence the policy and legislative debate. And whether that's something as simple as joining a trade group, or whether it's something where you're putting a little bit more resources and coming up with a bespoke policy strategy for your business, I would now say that that's kind of a fifth prong and a fifth area where you need to have a strategy dealing in the current market.
Jeremy, would you like to add on to that?
Yeah, I think Robert brought up a ton of great points, and I think at the core of what he's describing, I know the clarion call generally, when we talk about regulations, it's always the call for regulatory clarity. I think what Robert hits on and what we experience in the industry a lot is almost as necessary, while that's important, but almost as necessary as regulatory efficiency. As Robert brought up, across the federal landscape, there are a host of requirements that currently exist, but that even beyond that applies at the state level and even the international level. I think it's important to note that some perception is that, well, the regulations don't exist and that there's, this is going back a little bit, but it's the wild, wild west. I've never found that experience. To the contrary, I found that there's almost an abundance of regulations. It's just hard to navigate those once you're within the industry. Robert brought up several with the IRS, FinCEN, CFTC, and SEC. And that regulatory regime has existed since 2013. If you're looking at FinCEN and the money service business regime, and what you have to do as a business in order to have money transmission licenses, follow BSA, registration requirements. But you also have to consider, because of the way the industry works, the international impacts through the travel rule, through FATF guidelines. And I think it's important to note throughout this conversation, a lot of times it's brought up the challenges and the problems that certainly are very real, but for those in the audience or those who are trying to operate in the space, and we're all trying to encourage that, resources that exist in order to help navigate that landscape. And I don't want it to be the takeaway to be that there isn't any help and it's a lost cause, because I do think the Global Blockchain Business Council recently released global crypto asset standards and 64 guiding principles that are very important to leverage and apply for businesses looking to navigate the landscape. And similar guidance, I think, exists in a lot of different areas through, WEF, Bank of International Settlements, Financial Stability Board, and others. So I do want to make sure and highlight the fact that as challenging as it is, there are resources out there to help with the process and getting through all the different requirements.
Jeremy, I think that's a really excellent point. And I think too, I want to just reiterate the fact that I think there is a general belief that there hasn't really been, or there wasn't a lot of regulation in this space until the SEC started getting involved in enforcing against ICOs starting really in 2017 and 2018. But there has, of course, been a regulatory regime for crypto exchanges and particularly custodial exchanges, as early as 2013. We started having clients, as soon as FinCEN came out, to your point, with its guidance in March 2013, clients started reaching out to us to find out what that meant for them. And one of the very clear indicators was you do need to register with FinCEN under that guidance, but FinCEN isn't really a prudential regulator. And so the idea of submitting to prudential regulation, particularly as a way to create a feeling of safety for your customers, a feeling of security, a feeling that you are, it creates an ability to really position yourself as a forerunner in the industry, particularly here in the US, if you can show that you are regulated. And we have a number of we have a number of clients that over the years have chosen to pursue regulation, particularly with the states and state licensure as a money transmitter for that purpose. And I think that the states have really, to the extent that there is a perception that the states are somehow behind on this, I just don't think that's true. I mean, since 2015, we've had New York's BIT license in place, but even before that, we've had states very much working together to think about these issues. I was in Oregon the week before last, meeting with the Money Transmitters Regulators Association, and I can just say that there is a lot of knowledge in this area. There's a lot of interest in this area, and there's a lot of willingness to engage with crypto companies. And there were a lot of crypto licensees at the conference. And regulators love meeting with their regulated constituents. And so it was a really productive conference. Great conversations were had, and I think that it just goes to show that when you submit to regulation, when you cooperate with your regulators, it can really be a point of differentiation in the industry.
Anyone else want to add on to this topic, or we can move on to our next question?
Well, maybe just to cap it off, another soundbite that I like to share is that, I think there can be a fundamental disconnect between the tech community and sort of the regulatory community that has certainly surfaced in the crypto asset market. And I think it stems in many ways from sort of the late 90s, early 2000s technology ethos of move fast and break things and pay for it later. And there's a big difference between then and now, because back then you were dealing mostly with information, which was mostly unregulated. And even now, that same information is regulated in ways that it wasn't back then. But fundamentally, with a crypto asset, you're not dealing with information. You're dealing with what is essentially a financial asset, and usually a financial asset that falls into more than one of the different categories that we've been discussing. And so that's why the sort of the traditional tech ethos of move fast and break things just doesn't work in this industry. And I think any of the professionals on this call would tell you that you'll be a lot more successful if you sort of have a proactive strategy to understand the regulations that do apply to you, because there are probably more than one framework that does apply to any given business, and have a strategy for how to navigate that.
Yeah, and I think that goes industry-wide, Robert. I think that's a great point, that there is somewhat of a tension between, that central ethos of crypto or decentralization, which is vitally important, but also bringing that into the fold of regulatory frameworks and a more mature and compliant way that I think too often are seen as mutually exclusive ideas when they're really not. Being in DC, we meet with legislators, regulators, staff, and so forth. And a lot of times I walk into the room and I think they expect me to be, having a torch and a pitchfork in my hand, looking to overthrow the government and abolish all banks. And we're still working through that idea of, DeFi and crypto and digital assets does not mean complete, anarchy and abolishing existing institutions or regulatory requirements. It's got to be a marriage between the two.
I think on the opposite end of the spectrum, though, you have kind of a lack of coordination amongst a lot of these regulators. And so you have this one side that's kind of like crypto anarchy, and let's do our DeFi applications and throw them on the chain, and nobody's going to tell us otherwise. But then on the other side, you've got all these regulators that are like, okay, go get your MTLs, go register with FinCEN, do this, that, and the other thing. And then the SEC can still come in and say it's all security, so none of that really matters. Or you're offering derivatives and you're not adequately, protecting off the U.S. So I think there's just this lack of a strategy. And now with proposed regulations out of the IRS, you're going to have to collect information whether you're an MSB or not. So I think a lot of the crypto industry is frustrated with, like, let's just block the US and do our thing offshore where it's more coordinated. And the US hasn't really gotten the message that, hey, we need to get together as a regulatory, as many regulators and figure out a strategy that can work for the industry.
So it seems like we touched upon the regulatory fragmentation and the aspect of this unclear landscape. Also want to talk a little bit about basically SEC's perceived approach of regulation by enforcement, or this general reactive case-by-case approach. As the SEC states, is the existing framework really sufficient? I think we can start with Tiffany.
Sure, happy to address that. So, I mean, I think it's absolutely accurate that the SEC is proceeding by a regulation by enforcement approach. Like generally what happens is you have, you know how to categorize an asset, and then you know which rules to apply to it. What happened here is that, as everyone was like discussing, crypto assets, virtual currencies, we've changed the name about the assets, they've morphed over the years, but they have been regulated at the state level as money service businesses or sometimes trusts. And essentially you have the SEC coming in years later saying that these assets are securities, and they're not like giving clear guidance as to how to make that determination. And we spend a lot of time, energy, effort, and money, the companies do, to try to make that assessment. And once they make that assessment, that gives the SEC jurisdiction and the ability to, apply all these additional rules. But if you think about the way they're approaching this, it's like really inefficient, because what we have is you have the SEC first over the years, they're going against really what I would deem the low-hanging fruit. They're going to be smaller companies that don't really have the resources to fight them. And a lot of times there are companies that were no longer operating in the US. So they had these settlements, and the companies were able to settle most of the time because they didn't have the resources, but they really also did not have any incentive to actually fight the SEC. So the SEC points to that as like precedent that they have jurisdiction. What they're doing now is they're going up against companies that are going concerns. So the larger corporations, the larger entities, and why they picked Binance and Coinbase versus other companies, I can't tell you. No one really can, right? It seems kind of like random, but we're in a place where you have the SEC bringing actions against crypto platforms in different courts where you can have different outcomes. And we see a little bit of this in the holdings in Ripple and Terraform. But just taking a step back, what does all this mean? It means that it's just totally inefficient. Like, right, there's a lot of different ways to give clarity. There's a lot of different ways for the SEC to proceed, and they're not doing that. They're not creating rules pursuant to the notice and comment period, as they've done for other types of assets. Instead, we have enforcement actions, which really don't put the industry on notice as to what they can and cannot do. And there really isn't a paradigm to actually register. They say come in and register, but there's a number of firms who have reported publicly. I've also been in the room with them where you're having discussions about how to actually make the regulatory framework for securities, where you have intermediaries, you have things like DTCC, which is a centralized clearing, all of these things that don't apply to crypto. And you need guidance to be able to make that applicable to crypto, and the SEC just hasn't provided that guidance. And so what you have now is just a bunch of actions, right, where the SEC and these crypto companies are essentially fighting for the livelihood of their business. And if they don't engage in those fights, their only alternative is to essentially shut down or become a Bitcoin-only exchange.
Mitzi, do you want to add on to that?
Yeah, I think one of the maybe frustrating things, right, is that within this industry is that there's a lot of nuance, and sort of painting everything with a broad brush is very challenging, right? I think that's why you're seeing, even in some of the, not just to talk about specific cases, but some of the more egregious conduct cases, there are still issues that I think are worth sort of looking at in those cases. And that's why you're seeing a lot of sort of amicus briefs, right? And sort of other people in the industry talking about specific issues in a particular case, whether that has to do with privacy or whether it has to do with, something else, right? That's sort of tangential to this broad, sort of sweeping enforcement action. But I think that's where, it gets very interesting. And I feel for companies where it is, really easy to take sort of a small settlement, right? So you can sort of, move beyond that. But I do think that for the industry, you then end up with these cases that are not helpful, right? And sort of sometimes it is sort of the low hanging fruit, and sometimes there is egregious conduct, but there's also a lot of nuance in activity, and it shouldn't be brought up under this sort of sweeping rug of, the whole thing was wrong, right? There's a lot of nuance. And I think that's what a lot of people like about the crypto industry, because it is not just black and white. There's a lot of gray in terms of what these assets do, what service providers do, that the current existing laws don't actually cover, right? There's a lot of space in between that and interpretation.
Mike, any final thoughts on this question?
Yeah, I think part of the SEC strategy here is to kind of not move forward with any real regulatory guidance and continue to bring these enforcement actions and just pull crypto within its existing market structure for equities, debt, other types of assets. But the reality is that none of these crypto assets look anything like, or very few of them look anything like a debt instrument or an equity instrument. And so you wind up with these enforcement actions essentially deeming through the agency's settlement order various crypto assets, oftentimes in and of themselves, but per the reading of some of these crypto asset securities lingo that they throw into the orders, deeming the assets themselves almost to be crypto assets. And you look at some of the guidance with respect to special purpose broker dealers and other market participants, and it makes no sense. Like, the agencies essentially said you're selling them as investment contracts, but then they're crypto asset securities, so they need to be custodied a certain way akin to other types of securities, and none of it really fits together. So what you wind up with is a market structure that makes no sense for crypto, and so it just goes offshore. And I think that's a real problem. There's a missed opportunity that the SEC really has to go out and issue proposed rules that make sense, that fit within the enforcement actions they're bringing, but they've just not done that. I think it's really created an environment of confusion. And the latest action involving Stoner Cats, the NFT project, really hits this home, where the actual press release says there was an unregistered offering of NFTs, and the order itself in one place says that there were securities offered in the form of NFTs, and then another place that says they were offered and sold as unregistered securities. It's all just confusing. And the SEC has that ability in an enforcement action to put the language they want in the settlement order, and you can negotiate it down to an extent, but they put with the language they want in the order, whereas a judge would have a very different way of evaluating the facts and putting together the order. And then they can say whatever they want in a press release. So I think it's really a difficult situation where the agency that you're dealing with in this context has a lot of authority to create confusion and to really lead some of these projects down a road that they're not prepared to go down.
Got it. So in your opinion, what are the most important regulatory actions undertaken by the federal and state authorities, and why? I think we can start with Robert.
I would say, in general, I think the most important actions are those related to fraud. And, I think when we look back on this industry a year or 2 years ago, most of the enforcement actions that we were seeing were pretty squarely related to fraud and consumer protection. And I still think that those are the most important enforcement actions. My hope is that there continues to be a focus on preventing fraud, protecting consumers, because those are all foundational to allowing the industry to grow. To the point of what some of the other speakers have been saying, I think we do need to kind of turn the corner and pivot toward an enforcement environment that is a little bit more nuanced, where we are giving industry actors who are not engaged in fraudulent activities and who are taking steps to protect consumers the ability to allow their businesses to grow and sort of experiment with new business concepts.
Yeah, I agree with Robert 100%. I mean, and if you look at the history of the SEC's actions, like, right, the 2017, 2018, 2019, like the ICO ones, for the most part, those were about fraud, right? And those are a lot of the actions where, you really didn't see people fighting, not only because of the resources, but because they were bad conduct. You really didn't see as much criticism of the SEC. What we're seeing now is actions where there are registration violations, where there are no allegations of fraud. And so just like thinking about like first principles and what's actually important, it's important to protect investors, and we can all agree about that. But what's not what we shouldn't be doing is trying to force an industry offshore. And I think the other like regulatory actions that I think are like important that really don't get enough credit are like all of both the enforcement actions and the guidance that like states like New York are putting out. And so they've had the BIT license for many years now. They put out guidance just last week, giving additional guidance to their licensees, including like inviting them to come in and discuss their policies and procedures with respect to listing coins with the staff there, which again shows like the collaboration between the industry in New York. The ability to actually get a meeting with a regulator and talk through something is critically important. You don't see that on the federal side. And the other thing that New York did that I think is like really critical that doesn't get enough attention is they brought massive enforcement actions against 2 crypto platforms. And both of those actions were in the context of them examining those firms pursuant to their BIT licenses. And so it's saying, number one, we have a regulatory framework for you to come and register with us and become licensed. And 2, we're actually going to enforce it. It's not we're not just window dressing. It's tough. We're gonna have fines up to $100 million. And one of the fines actually had it was $50 million payable to New York, but the other $50 million had to be invested. I believe it was the AML policies and procedures with respect to the company. So I think those are good. Those are examples of like actions that a state or a regulator has taken that are actually helpful for the industry and help it move forward.
Well, one more thing I'll highlight with respect to enforcement actions is I do think it's going to continue to be critically important for the Department of Justice to bring enforcement actions related to transnational money laundering using cryptocurrencies. Overall, money laundering using cryptocurrencies represents a small part of all of money laundering worldwide and through the traditional financial system, but it is an area that I think is of high concern, especially when you've got large transnational criminal organizations that are starting to use cryptocurrencies and darknet markets to expand their operations. And so I just don't want to lose sight of that when we talk about enforcement actions, that the DOJ has done a lot of great work in that regard, and I think that will continue to be paramount.
Do you have any other developments flying below the radar that we want to highlight during this webinar? If not, we can move on to our next topic.
Yeah, Wendy, I'd like to bring up a couple of things. I think Robert brought a great point about the concern of illicit use, and you're starting to see some legislation be introduced related to that, namely the CAN-C Act, targeting nation state actors, which continue to be, in my opinion, the biggest problem in the industry. A lot of the fraud and illicit use that we discuss, really compared to what they're doing, is a very, very small percentage. But to answer your question, I think there are some important developments that are going to promote the industry and give it opportunity to grow that don't get discussed a ton. Robert hit on it initially in his opening statements about the IRS. I think the IRS, their proposed tax reporting regulation is very encouraging on a couple of fronts. One, addressing the broker definition to exclude miners, validators, staking pool operators, developers, and others from that definition is really important, because in a lot of discussions around this, that broker-dealer definition and the requirements around them, it does capture all of those lines of effort. Defining digital assets, even as a concept, is important. And also addressing tokenization more generally. I know this conversation, a lot of conversations focus solely on digital finance and crypto, or Tiffany mentioned the different terms used for it, but it all at its core has a financial element. But tokenization at large, in terms of everything from real estate to other industries, securities, commodities, which may fall into the financial markets, but that tokenization element that the IRS starts to discuss is really important. And the other element that I feel didn't get enough attention was the Fed issuing 2 letters about supervision of novel activities. the banking industry and its ability to incorporate and house or facilitate, sponsor, hold digital assets is really where this needs to go in order for it to be a greater level of adoption. And so the Fed recognizing that novel activities, which are facilitating the conversation, encapsulates crypto, and having guidance be provided to banks so that that will start to be reviewed, and they'll issue non-objection letters if banks want to participate in those novel activities. I know we've been down this road before, and the doors seem to open and close in a couple different ways, but they're still willing to have the conversation, which I think is important.
Jeremy, I wanted to, thank you for bringing up the CANSI Act. I think that Treasury and Congress both have indicated this year in particular that they are very interested in bringing potentially DeFi protocol providers into the regulatory perimeter, which has been something that I think has flown under the radar a little bit. So in the spring, Treasury issued its DeFi risk assessment. So a risk assessment is it's not guidance, it's not regulation, but it does indicate how a regulator is thinking about its current regulatory remit. And what was really interesting about the DeFi risk assessment that was published this spring is that it shows Treasury may view itself as being able to apply current definitions within the Bank Secrecy Act and those implementing regulations to DeFi protocols without the need for new rulemaking. Which is really interesting because I think there's a lot of understanding in the industry right now that, you would need something like the CANSI Act in order to regulate DeFi. And the CANSI Act, of course, would apply both sanctions and anti-money laundering requirements and obligations similar to what falls on custodial providers now to non-custodial and decentralized protocols, as well as potentially their investor backers, which is a really unique aspect of that bill. But the risk assessment and also just statements by Treasury officials over the past year, including Deputy Secretary Adeyemo at Consensus and as early as 2022, indicates that Treasury doesn't necessarily feel it needs that legislative mandate in order to begin enforcing against DeFi protocols. So I think that's something that, we're certainly counseling our clients in that space to take steps to protect themselves in that instance, but also it's just something to look out for. And certainly, if you have clients that are undertaking, lobbying efforts, something to think about, because I don't think it's getting quite as much attention as it could be right now.
Yeah, and related to just highlight Megan's great points about DeFi, following on that risk assessment, IOSCO published beginning of September their global approach to decentralized finance. So for folks who aren't familiar, IOSCO is the International Organization of Securities Commissioners. And again, they focus on trying to find, a central person to be the person to which regulations are imposed upon. So that's something to keep in mind when we're thinking about crypto generally, since it's a global asset. And, speaking of regulators who believe they already have jurisdiction over DeFi, another example is the SEC. They had a proposed rule last year to modify the definition of exchange. There were, they use a term communication protocol. The DeFi community got up in arms and said, we think this refers to DeFi. Like if you're attempting to impose a rule about DeFi, you need to follow the notice and comment period. Then back on April 14th, the SEC actually reopened the rule and was clear that it meant to capture DeFi, and that it takes a position that if you are a DeFi protocol or developer, and they were very squishy as to who the regulations would apply to, that if you offer the functions of an exchange, you could be required to register today. So DeFi is another very important hot topic that I think we're going to see a lot of more guidance and more action coming in the future.
And just to follow on that and kind of tie it back to some of Jeremy and Michael's comments, the new IRS proposed regulations also address DeFi and would almost certainly consider a DeFi platform to have reporting requirements as similar to a broker dealer. And so I think what this is telling us is that DeFi is really a target from multiple different angles. And I think that one of the another kind of emerging topic in the industry here in the US at least is building out infrastructure to help crypto asset companies and companies dealing with crypto assets to build a more user-friendly experience. And I think I'll take this opportunity to highlight that part of that could be building out infrastructure to help meet some of these reporting requirements that are almost certainly on the way, beginning as early as January 1st, 2024, or January 1st, 2025. And certainly if some of the regulations that Tiffany and Meagan discussed related to SEC and FinCEN enforcement come to fruition. So, as businesses in this industry start to think about the user experience and how they can kind of build on the infrastructure on their platforms to make them more friendly, more user friendly, I encourage them to think about how can you make them more regulator friendly as well, because I do think it can be done. It's not going to necessarily be easy. Some pieces may be potentially impossible, but to the extent that infrastructure is able to be built, that makes it easier to comply with reporting obligations, I do think that should be a focus. And I'll just touch on two more emerging issues that I think are notable, and interested to hear the other panelists' thoughts. And more kind of on a positive note, the grayscale opinion has potentially opened the door for a Bitcoin ETF one day, which would be a really positive development for the industry. And then another quiet development is FASB voted on new accounting rules for digital assets that allow fair value mark-to-market accounting, which is going to make it a lot easier for companies to hold digital assets on their balance sheets. And so I do think there are some positive developments too that we're seeing recently. And one more thing I'll comment on with and Jeremy, going back to one of Jeremy's comments about the Federal Reserve letter, where the Federal Reserve sort of intends to take more oversight of banks that are banking the crypto industry. I found it quite interesting that around the same time that letter was issued, we had a major fintech firm, non-bank fintech firm here in the US, issue its own stablecoin. And so, while sort of the banking industry is sort of all taking a step back, I think parts of the fintech world here in the US continue to take steps forward, especially with regard to stablecoins.
Got it. Our next topic is, where does the US government and the Biden administration stand in terms of regulating the digital assets? Any thoughts on the recent crypto bills that cover digital asset classification and stablecoin regulations? Maybe Jeremy can start.
Yeah, I'll jump in. I think, talking to the folks around the Hill, they see it in four categories. First is stablecoins. I think historically stablecoins have always been what the industry and legislators can agree on. They're linear, they're logical, they don't have quite the same complexity as a lot of the other offerings in the industry, and so there's more of an appetite legislatively to approach them. There's backing, there's reserves, and so forth. I think the Keep Innovation in America Act is, of the bills that have been proposed, that which may have the most chance for success, although unfortunately I don't think any of them have a great deal of success of getting across the finish line. Similarly, Fit 21, and then as a fourth category, what we talked about with the CANC Act, the problem for nation state actor involvement, particularly North Korea, to continue to fuel their agenda and campaign using crypto and fraudulent obtaining of crypto is something that I think Congress is very focused on addressing. But I do think the Clarity for Payment of Stablecoins Act, great to see the bipartisan participation and support. If we can keep it as a bipartisan conversation, I think that is extremely important and will really facilitate movement. The Keep Innovation in America Act, similar to the IRS rules, having a broker definition and excluding minors, developers out of that requirement is very important. Financial Innovation and Technology Act for the 21st century, Fit 21, also has some great elements, bipartisan support, empowering the CFTC and giving them more authority over the SEC. And also the CBDC Anti-Surveillance Act, important conversation around CBDCs. I do think that's one area that has a lot of ambiguity, whether or not, the U.S. is going to pursue it, and all the questions around it. Challenges with that are that is becoming a particularly bipartisan issue that I think will really limit its chance of success. But a lot of different approaches. The fact that even that there's a subcommittee dedicated to digital assets, and that was created in this last Congress, in and of itself is important. And so this is part of the process of making the sausage politically, that hopefully we can get to a good bill that doesn't just promote policy. It's the old cliche, right? Bad policy is worse than no policy or legislation. So hopefully we can get to the point of some good legislation that comes out of all of these different conversations.
And I'll just add on to what Jeremy said. I'll make 2 points. One is that I think that to your point, Jeremy, I don't think we're going to see necessarily the passage of any of these bills on its own, until the next election cycle, most likely. Just in a divided Congress, there just isn't the political will to go forward. But what we could see, knowing, as you mentioned, that national security is, of course, always a primary concern, prevention of money laundering, prevention of the use of these digital blockchain technologies to facilitate sanction activity or money laundering activity. One thing we could see is the inclusion of language from certain of these bills in must-pass legislation, like the National Defense Authorization Act. And so that's something certainly to watch out for. That's something that we're counseling our clients to be on the lookout for, and to have the legislative affairs teams monitor as well, because that could be a way to get some of these, some of this policy into law without actually passing a crypto bill necessarily. The other point I'll make is just that I think there's a lot of interest by the existing the state regulatory regime, Conference of State Bank Supervisors, the Money Transmitters Regulators Association, very, very interested in the federal bills and particularly on payment stablecoins, so the Clarity for Payment Stablecoin Act, what role they would assign to the existing state regulatory regime. And I think any bill that acknowledges the existence of that regime and that allows that regime to continue regulating their current constituents is going to get much more support at the state level from these banking departments and from, and also their constituents, which includes a number of entities that are already regulated here in the US, including a number of major fintechs.
I would just add that the McHenry-Thompson market structure bill, which also is, unlikely to pass in the next year or two until after the election, is an important piece of legislation, and it really codifies a number of exemptions that would be helpful under the securities laws for offering crypto assets. And given the lack of clarity, this is also something that the SEC could largely do through its own regulatory authority through proposed rules. But generally speaking, until we get something like that, there's this really impetus to go offshore and do a Regulation S offering or offer only to a limited number of investors. We really don't have a tailor-made structure for issuing crypto assets in the US. And that's something I think we should demand from the SEC, frankly, and really, regardless of whether we get legislation, we should be pushing the SEC to actually issue rules that allow people to do the things they want to do under the regulatory perimeter. And I also think having a market structure where you have regulated exchanges that are crypto asset only exchanges, potentially regulated by the CFTC or even the SEC, would be really helpful for the market. And so this is something, just generally speaking, that should be table stakes and we should really be pushing through, and I think are going to delay the development of the industry when many of these assets are not being offered or available in the US. And other regulatory regimes like the UK, EU, Asia, they're all allowing for these types of products to largely come within the regulatory perimeter.
Before we move on to global regulatory landscape, I want to quickly touch upon the concept of Operation Chokepoint 2.0 and some of the banking uncertainties we have in the US. So would love to hear your thoughts on what is coined as Operation Chokepoint 2.0. And there has been a lot of banking charter expirations and delays. So just your thoughts on that and what might be the reasoning behind all these movements. Maybe Tiffany can start.
Sure, happy to. I mean, so the real reason behind really the changes is the change in administration. So going back a bit, in 2021, when Brian Brooks was the head of the OCC, they issued 3 interpretive letters, which allowed, national banks and federal associations, which are licensed by the OCC, to engage in 3 types of services related to crypto assets. And those services, those letters are kind of opened the door, and which resulted in having 4 native crypto banks apply for OCC charters. And after the change in administration, all of the banking regulators, the new OCC, acting comptroller, as well as the other banking regulators like the Fed and the FDIC, came together and said, we shouldn't have the OCC kind of acting on its own ahead of the other banking regulators. Instead, we need to kind of coordinate. So they conducted a bunch of sprints and a bunch of studies to try to understand how they should be, regulating. And what that's resulted in is the guidance that Jeremy mentioned, earlier this year, and this was post FTX, right? So that we're in crypto winter. So I think that has something to do with it, but you really had the banking regulators, the prudential regulators come and say, you banks have an obligation to monitor the regulatory perimeter and not let the loss and all of the contagion from crypto spread into the banking system. And so they had this, public guidance, but anyone who represents crypto companies know that, those crypto companies started to get debanked. There were additional obligations on the banks that were actually, offering services to the crypto companies, which resulted in some of them getting, debanked and they didn't have services. And that has resulted in some think that's, kind of related to what happened with like the banking crisis. But that's really like what has happened kind of behind the scenes. And that's why people are referencing it to as Operation 2.0. It was really like an assessment by the prudential regulators that, crypto should be out of the banking system. If you look back a couple of years ago, it was like bring crypto into the banking system, that would be safer. But now we're kind of like forcing it out. And that's resulted in kind of like, now we're left solely with Anchorage. We had 4 banks that were, had conditional OCC charters, and now Anchorage is the only one left. So more to come there. There is guidance suggesting that folks should come in and talk to the banking regulators. But like what we're actually seeing practically and hearing from our clients has been more of a forcing, the crypto companies out of the banking system and making it harder for them to find banking partners.
I'll just follow on to that, and I'll note that I think, part of what we saw over the last couple of years is there, as Tiffany knows, there was this initial push to have banks bring crypto companies in and give them bank accounts. But what ended up happening was there were only a handful of banks that were willing to do that. And so instead of, hundreds of banks across the country taking a small percentage of crypto clients, we had just a handful of banks banking a large percentage of the industry. And that's what has kind of, in part, resulted in some of the negative consequences from the banking sector. And unfortunately, it's just scared off those banks that were not banking crypto before are now just even more scared to bank crypto clients. And so it's a critical question that I think the banking sector has to grapple with, which is how do we allow banks to bank crypto companies responsibly and in a way that they can get comfortable with? Because if banks are not banking crypto companies, it's actually exacerbating the anti-money laundering risk. And so we need to find a way to bring them into allow them to have bank accounts with traditional banks, bring them into the traditional banking infrastructure, which brings them into the remit of the Bank Secrecy Act and some of the protections that it provides. And I think we're at a point where we're really at a kind of a loss now, because as Tiffany noted, right now we're seeing more and more banks close accounts for crypto businesses and take a step away from being open to banking those. And so it's a real problem that I think needs to be solved within the next year.
So we do have a little less than 10 minutes left, so we will be moving on to the Q&A. And there are significant amount of overlaps between the questions that we prepared and the Q&A as well. So To move on, current global regulatory landscape. What do you see as the main contrast between the approach of the US and other global jurisdictions? And what might be needed in the US to have a comprehensive framework similar to what other states have been proposing? Because one of the questions that we had was, why is it that the US does not go in the direction like EU MiCA route? Because this would create regulatory clarity, but how difficult would it be for the US to actually have something like that?
I think part of the reason that we see a distinction in the US versus Europe and other jurisdictions is in part based on how we've structured our market regulators. So we have two as opposed to a single market regulator as most countries have. I think US might be the only one with like a CFTC that regulates derivatives and a SEC that regulates securities markets. And that really creates a tension between the two. Even back when I was at the CFTC in like 2013, 14, when we were looking at Bitcoin, we weren't sure if it was something that we had jurisdiction over or if it was something that the SEC should properly regulate. And so we had to do a bunch of analysis to kind of determine that that's something within our remit. And I think that's a problem because both regulators are jostling for jurisdiction. More broadly, I think the reason that Europe has moved forward is it's very political in the US. I think there's a strong political partisanship around crypto. There shouldn't be, but there is. And that's really delayed a lot of this. Some feel very strongly that there shouldn't be any legislation or any sort of regulatory framework for crypto. Others feel that there should be. And the Republicans that are typically the ones saying there should be no regulation or actually in favor of regulation here. So I think it's a little bit of an unusual political issue. And so it's really a matter of getting some legislation in front of everybody that they can agree on. But that's the approach, I think, in Europe of first starting with the centralized providers, then moving to DeFi really makes a lot of sense. And in the US, we've almost started to do the opposite, where we're just jumbling everything together. We haven't even figured out centralized exchanges, and we're looking at DeFi already. So I think there's just a little bit of politics at play in the US.
I think
I
too.
was also, oh, God.
Sorry, Misty. I was just going to say, I think too, you have to consider the fact that the U.S. has a very unique federal system that's imbued the federal government with certain enumerated powers and reserved the rest for the states. And so, absent Congress passing specific legislation designed to preempt state law in certain areas or fields, like money transmission regulation in this case, you're going to have this dual set of laws being passed by the federal government with respect to commodities regulation, securities regulation, and then the states with respect to non-bank financial services. And so it's a unique aspect of the way our government is set up, and it's something that has to be solved for by congressional action, specifically through preemption. So I think that's one of the reasons that that we differ in many ways from Europe and others that have been able to really form a consensus around major legislation that really occupies the entire field, like MiCA.
Yeah, I was going to say exactly, sort of very similar, that it is sort of a product of our historical, sort of country and how sort of we came to be. But I would also say that, it is a opportunity now for, companies and even individuals, right, to sort of talk to your Congress, folks, right, talk to people who are representing you in Congress and, government, and so that people know that this is important. Because I think part of it is, we do need to see not just, certain companies sort of making all the statements, but we also need to see, people use crypto, right? And people say this is important to, how I interact, and, more and more sort of consumer applications so that people sort of see it in the public sphere. So I think that's also a great opportunity, just given, everything that's been going on in terms of, whether or not legislation is going to pass, sort of who's going to be the next president, all of that. But at the very base layer is, talk to your representatives and make sure that you're heard in terms of your voice.
I think Mitzi really brings up a great point. The most consistent feedback I hear from people in the legislative space is, give me a use case. Why do my constituents care about this? Why should I be discussing this as a representative? And that's something that, the industry needs to get better at. We need to get better at. And I do think somewhat contrary to the idea of crypto and decentralization. As Robert mentioned, JPM getting involved, as the Fidelities and the BlackRocks and those start moving more into the space, legislators are going to see the use cases on that institutional level, and will probably move more quickly once that becomes more formalized.
One question on the outlook. Are you seeing any general shifts in the outlook, questions, and concerns among your crypto-related clientele? Like, what's their main concern? Like, what's their main focus point right now?
Yeah, from what we're seeing with our clients, it's a lot of what we discussed today. It's concern about operating in a space when the rules are unclear or change or are inefficient. I think Tiffany had great points about just the effort involved in order to navigate this space. It's highly inefficient, it's consuming, it's costly, and it's contrary to effective business operations. And that's one of the biggest concerns that we're seeing.
I would echo that. I mean, I think we're seeing a lot of clients consider, other jurisdictions, right, as you might imagine, where their business can thrive. And it's not, it's clear, it's not going to threaten the very sort of existential existence of their operations, and it's something that they can, comply with, right? And so, I think people still have hope that the U.S. will come around, but I think, as we, and, frankly, a lot of my clients have started sort of moving in that direction. But, that's some place where I think we do have the opportunity here to sort of try and at least stay that, right? And so that companies are not completely leaving the U.S. And, in 10 years, we're not going to be part of this conversation. That is something that I think a lot of people are sort of concerned about. But I think there is, in terms of, what with the lobbying efforts and sort of, a lot of the efforts with talking to trade associations and Congress and your representatives and all of the folks who are sort of thinking through these issues at sort of the government level. I think that I think there's still an opportunity here to really try and shape what we think, the principles here in the United States should be.
Yeah, I think there's a little bit of a bias against some of these legacy crypto businesses that tried to comply with the 2017, 18, 19 guidance on the books and developed, a model. They developed a protocol, issued a token, all of that. And now they're really afraid of an enforcement action. And it's very hard to redo what they've done in the past. And there's not really a willingness of the regulators to work together with some of these legacy crypto asset businesses. And then you have a bunch of new entrants. You have a lot of financial institutions that are getting into the space. Citi just launched its own private blockchain. And it's a lot easier for the newer businesses to come in and try to comply best they can with what's on the books. Guidance around, for example, not launching on Ethereum if you're a prudentially regulated institution, or if you are a fintech, you can go launch on Ethereum, that sort of thing. I think there's a little bit more to comply with. It's a little bit easier for some of the new entrants to find a path, but it's still super difficult, and we don't have hard rules. And these, for example, just the proposed IRS regulations, which, it's about 80 pages of a definition of broker that's very complex and seemingly loops in almost any business in the ecosystem, unless you're running a node or offering a pure software product with no front end. So it's really difficult to comply, in short. And I think that's where we're left with these regulators, where they need to kind of get their coordination going and work with Congress to get some legislation.
I'll just add quickly, because I know we're on time, close to time. Like in this interim period, like as we talked about, like we're probably going to get a bill in this Congress, like, right? But in this interim period, the other thing that crypto clients are really focused on is the various court cases. And so the SEC has brought these cases, and like if you look at Ripple, Grayscale, it's not just, the court cases aren't immediately and just automatically going in the SEC's favor. And so depending on the results, and it's going to be very, confusing because we're in a number of different courts, but it's important to keep a close eye, because that may actually give us like judicial clarity in the shorter term before we actually get a congressional bill.
Okay, so that's all the time we have for today, but thank you so much everyone for attending the webinar, and also a huge thank you to our panelists for all their amazing insights. I hope this was a valuable session for all of us and hope you have a great rest of your day. Thanks everyone.